If you own a beautiful building that's newly renovated with all new systems in an improving area, why would you sell that? You're much better off levering it up, using the proceeds of the loan to return some capital to your investors, and then just owning the thing and allowing the rents to rise over time and therefore the value to compound tax-free.
Hello, and welcome to Sink or Swim, a weekly podcast brought to you by RentSync, where we take a deep dive into the PropTech, multifamily, and rental housing industry. In each episode, we uncover the technologies and strategies used to help overcome operational challenges and increase the value of your multifamily investments. So, let's get into our conversation today.
Okay, welcome back to Sink or Swim. I'm Mitch Fanning with RentSync, and joining me today is Moses Kagan, the co-founder of Adaptive Realty, a Los Angeles-based real estate private equity firm that focuses on boutique apartment buildings in, you guessed it, LA. Moses, how you doing today?
Very well, thank you. Thanks for having me on.
This is interesting. I'm glad to have you on because, initially I came across you from Twitter, and we'll get into that probably halfway through this conversation. But let's start by just kind of kicking it off by talking about, what is Adaptive and why you formed it.
Sure. So Adaptive is a real estate private equity firm based here in Los Angeles. We are, to give you a sense of the size, we're kind of approximately 175 million in assets under management, so quite small. We are laser focused on what we describe as sub-institutional scale multifamily. So that means projects anywhere between like 3 and 10 million total capitalization. We have renovated 100 buildings like that over the last 12 years. And currently manage approximately 105 buildings with about 750 apartments.
So, and this is probably something I was thinking about mentioning earlier, but, and we'll drill into that, what you just kind of mentioned. The thing that kind of was interesting about you and what you're doing is throughout the whole life cycle, whether it's, raising money to even selling, which I know you don't do a lot of, you do things kind of differently or kind of something that's not non-conventional, we'll say. So let's kind of start and drill into what, some of the comments you just made by starting off with, being a permanent holder. So I noticed you talk a lot about that. Number one, like why and, how do you kind of convince your investors to kind of come along for the ride?
Yeah, so maybe let's start out by talking about what the sort of standard real estate private equity model is, which is, buy a building with a bunch of debt, fix it up, and then and flip it as quickly as you possibly can, trying to maximize the IRR. And that's a great model for a lot of people, and it's particularly good for institutional real estate firms that raise money from non-tax-paying investors like pension funds and endowments. We work with taxpayers, and that means typically high net worth individuals and family offices. And those types of investors are highly sensitive to tax. So that's the first thing to say. But the most important thing I think to say is that Los Angeles is kind of a special market in the sense that it's severely supply constrained. So there's like a permanent imbalance between demand to live in Los Angeles and the number of new apartments that are supplied every year. And for that reason, what we learned after unfortunately selling some renovated buildings is that it really does not make sense. If you own a beautiful building that's newly renovated with all new systems in an improving area, why would you sell that? You're much better off levering it up sort of sensibly, using the proceeds of the loan to return some capital to your investors, and then just owning the thing and allowing the rents to rise over time and therefore the value to compound tax-free.
No, it totally makes sense. Just to talk about the supply constraint for a second, did it change in terms of an increase of supply based on just COVID? Like, did you notice that at all, or was it typical?
The experience we had during COVID was more on the demand side. So, supply for apartments is going to be based primarily, is based on development.
Yeah.
And so the units being delivered during any given year are ones that were planned and permitted and begun years before that. So it's not that we've had more supply during COVID. What we've had is less demand. And that's sort of taken two forms. One, at the bottom end of the market. So by bottom, I mean in the age distribution of the renter demographic. So the kind of like 22, 23-year-olds, those people did not come to LA in the same numbers as they have previously. So the ordinary cycle is people graduate college, and some percentage of them who are particularly ambitious and want to be in entertainment or tech or just love the idea of living in LA come out here. And those people, for obvious reasons, chose not to over the past year or so. So that leached prospective tenants out of the younger age range. At the upper end of the renter demographic, so people like, let's say, mid-30s to early 40s, a lot of those people end up leaving LA anyway in a normal year because single-family homes are so unaffordable here. So I think what happened is that people left earlier than they might have. It's like if you're deciding like, hey, do we stay here for another couple of years or whatever and then continue enjoying the nightlife and the bars and the, all that stuff.
Right.
Or do we go move to Austin or wherever else to be able to afford a home?
I was going to mention it.
Yeah, exactly. And so I think with the city, basically closed down over the past year, I think a lot of people said, you know what? We're going to move now instead of waiting for another year or two like we thought we were going to. So we've kind of lost demand at the youngest and oldest end of the kind of like renter prime renting ages, and we're starting to see that come back, particularly among the youngest tenants, and we're hopeful that will continue as time goes on.
So I kind of want to go back to my first question in terms of why you formed it, but also to frame that around maybe the 2008, 2009 period, because I think you have an interesting story around, at least I thought it was very interesting in terms of how you got, you financed your first building and you purchased your first building and so on, and some of the lessons learned. So maybe we'll start with that. Like, take us back to that first building and your experiences there.
Yeah, I guess I should start by saying that our decision to go into buying and renovating apartment buildings was not the result of some like well-considered strategic options strategy meeting. Well, my parents had always owned some small apartment buildings in upstate New York. In like 2007 or so, my brother and I were looking to just like buy a 2-unit building. He would live on one side, I would live on the other. And because the market was still like crazily inflated, the numbers for those type buildings were just totally insane. Like it was obvious even to our like fairly naive eyes that the numbers didn't make sense. And my brother found a guy who had bought and renovated a derelict 16-unit building and run out of money before he could finish it. And so with help from our parents, we purchased that building at a price which was very good relative to the existing market conditions. We could have bought it cheaper 6 months later if we had just waited. But anyway, so we bought that building, and that was our introduction to owning apartment buildings in Los Angeles. Still own that building today. It's kind of around the corner from here, and it's worth a multiple of what we paid for it.
Motivated sellers are always the best to deal with, I've heard. So
yeah, this guy he was underwater on the building because he was into penalty interest in his construction loans. So in order to make the numbers balance and be able to actually buy the building, we had to lend him $15,000 as a fourth trust deed on his home. And I've told this story a lot, and I always used to joke, well, and we'll never see that $15,000 again. Unbelievably, the guy managed not to lose the home during the Great Recession. And about 3 or 4 months ago, I got an email from an escrow company being like, please send us the payoff demand for the $15,000 fourth trust deed on this guy's house. And he hadn't been making payments to us, and he was in penalty interest to us. So we ended up, but he paid it off. I mean, it ended up being a great investment for us over whatever it's been, like, 12 years or something.
So this next line of questioning is really geared towards when kind of others are kind of running out of the exits, so, that old saying, kind of, that's the opportunity.
Yep.
And, just listening into another podcast that you were on, you made obviously you ramped up your investing over that period from like 2009 to I think it was 2012, but you kind of started to ramp it up. And I think there was a quote that you made, you kind of jumped in when others were running away. And so just totally off script, when you look at, say, this kind of 2020, another kind of, black swan event, if you will. Now, obviously, it's a different situation. Real estate isn't kind of, cratering. But how are you guys looking at that in terms of like, do you see opportunities in the market, or are you just kind of weathering the storm?
Well, we raised our sixth fund and we closed it in October of last year. And our thinking was when we bought it that there were going to be opportunities that, so I should say that California, and I guess the whole country, has an eviction moratorium, which means basically that there are a lot of owners who have tenants who are not paying rent. And so we assumed that there would be, or we suspected that there would be owners who would grow tired of owning buildings full of tenants not paying rent and would be willing to sell those buildings for reasonable prices. And so we were very optimistic when we raised that fund that there would be all kinds of stuff to buy. In real life, that did not happen. And we can talk about why that is. I mean, tenants probably paid at a higher rate than maybe some people were expecting. Owners probably had maybe more financial cushion, a little less leverage than maybe we thought. And also banks were willing to forbear on mortgages to a large extent. So that wave of opportunity never really appeared. And extraordinarily unusually for us, we have not bought a single building with that fund. And again, we've had it active and ready to go since October. Now, we have luckily been able to buy some other buildings using different vehicles that have different return expectations. So, we've been fairly active, but not with that fund. Again, because the opportunities have been so scarce.
Oh, it totally makes sense. Now, when we're, that's a good segue into the buying part of the conversation. You guys are known to look for, neighborhoods in transition, quote unquote. So let's start with the reason, why that is, and how do you even go about selecting like the property?
Yeah. So, I mean, I guess the first thing to say is that we're very quantitative in the way that we think about evaluating deals. We are focused almost entirely on unlevered yield on cost. And that's a very, very simple equation. It's just in the numerator, so the top half of the equation, it is forecast annual rents after stabilization minus forecast annual operating expenses. So effectively NOI, net operating income at the top. And then just divided by, in the denominator, the cost to buy the building, cost to renovate it, the cost to hold it during the time that we're renovating, and then, of course, our fees. So it's basically, what is the annual NOI once the building's stabilized divided by what is the total cost of the project. And then we're, depending on the vehicle for which we're putting out money, we'll have like a target for what the quotient needs to be. For our fund, which we haven't been able to deploy, we need the unlevered yield on cost to be like north of 6 right now. For opportunity zone stuff and some other stuff that we're doing, it can be a little lower. But that's how we think about things. So you asked, why are we interested in improving neighborhoods? Well, the answer is that there's only two real numbers that change in that equation. So that the cost of renovating a building, it doesn't matter if we're doing renovations in like the most expensive neighborhood in LA or the cheapest neighborhood in LA, like the renovation costs are going to be the same and the fees are the same. And the cost to run a building doesn't change. Like it doesn't matter if you're running a building in a fancy neighborhood or a poor neighborhood, like you're going to fix everything that breaks. You're going to maintain the building. You're going to clean it. You're going to have a gardener there. So you're going to insure it. So all of that stuff is basically the same. So the variables that matter are what is the purchase price for the building and what are the rents that you can forecast upon completion of the project. That's pretty much it. And so our job is to constantly be looking at properties that are on the market and running that equation and trying to find the ones that work. And so why look for improving neighborhoods? Well, in improving neighborhoods, you can sometimes, it used to be frequently, now it's much less frequently, but you can sometimes find buildings that are priced that are mispriced relative to the rents that you can get upon stabilization. In other words, like basically that the investors who are trying to buy real estate have not realized how good the neighborhood is, how high the rents can be once you're done renovating. So, our job is to sort of like stay abreast of those trends, look at where people want to live, and sort of like skate to where the puck is going, to use maybe a Canadian metaphor.
Do you think when it comes to like the renters and maybe even in your areas, do you think they're looking for that boutique experience as well, like almost versus the different types, like the different type of Class A's?
Yeah, we have, and that's a good point, and maybe we should talk about that a little bit. Our buildings are very unusual. The finishes look Class A, feel Class A. We use hardwood floors. We use, the design's really cool and modern, and it's a little generic so that it doesn't age, but it feels very clean and high end. What separates our buildings from Class A, though, is that because they're much smaller, we're talking about buildings with like 6 units, 12 units, 20 units. We don't have the kind of amenities that are in like a standard large Class A building. We don't have gyms, and for the most part, we don't have pools and, that kind of thing. What we do have, though, because they're small buildings, we have a couple of advantages that I think are not widely appreciated in real estate. One is, and this really came to the fore during COVID, these small buildings almost never have shared entries and hallways. Okay. So almost all of the units in our entire portfolio have their own front door. And there are a couple of good things about that. So from the tenant's perspective, it's nice. Like, they feel like it's a private thing. They're going to their own front door. They don't have any shared interior space. That's actually nice from a security perspective too. They don't have to like be worried about who else is in that hallway or anything like that. It's also very good from a efficiency perspective, both for CapEx and OpEx for us, because we don't have to renovate and clean and maintain a bunch of space that does not generate rent. So like you probably have heard people talk about the difference between like the square footage of the building and the rentable square footage of the building. Like for us, all the square footage is rentable. Pretty much every single square foot of that building is going to be generating rent for us. So that's one nice thing about our buildings. The other thing, and I think this is really not widely appreciated, it probably should be, is that when you build big buildings, the nature of geometry means that you are going to have light usually only on one side of an apartment. So if you picture a normal big Class A apartment building with a hallway running down a floor and you got apartments on either side of it. Okay. With the exception of the corner units, all of those interior units, the ones along the hallway, are only going to have windows going out in one direction. They obviously don't have windows going back toward the hallway, and they don't have windows going into each other's apartments. So it's just light from one side. Okay. And that dictates certain things about how the apartments are designed, but it's just like worse. Like it's just natural light is among the most important things that you can have in your house. And so when you do small buildings, your apartments are going to have, just by nature, you end up with all corner units effectively, or sometimes we have a lot of units that have light on 4 sides. So what that does, it's not something that people talk about a lot, but one, it improves regardless of how the apartment laid out, more light, better, right? But also, because the nature of apartment design, you basically need to have windows in each bedroom, right? That's a requirement of the fire code. By having light, smaller buildings means light on more sides, which means more flexibility in terms of how you lay the apartments out. Like you can have, because you're not hamstrung by only having light on one side. So like if you think of a standard Class A apartment, what you'll find is like a 1-bedroom, there's only light on one side. So they have to use part of that. One of the windows has to be for a bedroom, and the other one has to be for like the living dining room. And that's it. There's you can't do anything else because all of that space that's away from the windows kind of just has to be part of the living dining room. Once you get light on another side, it opens up all kinds of other ways to kind of play Tetris with the units. And that turns out to allow for much more efficient layouts. Anyway, so there's some major advantages to doing these smaller buildings.
Yeah, I mean, when I looked on your website, your units, are beautiful. If I was living in LA and I was renting, I definitely would be checking out your places.
Well, I should say there's an intentional thing going on there. I mean, obviously, we want to make nice apartments, but you need to go several steps past that. In other words, if you want to generate premium rents, right, it's not just about the apartment, it's about how the apartment is presented. And so there's a kind of like a chain of things that you need to get right, from like how the apartment looks in real life, to how it's staged, to how it's photographed, to how those photographs are used in ads and what the copy in those ads look like, to who the leasing person is that the tenants interact with when they reach out, when they see that ad and become interested in the apartment. And then obviously the whole experience of signing a lease, right? So how the apartment looks, like the finishes and the layout and everything, is important, but it's getting that whole chain of things correct and having them all hang together in like a coherent way that allows you to generate premium rents.
Interested in being a guest on Sink or Swim? Or have a really great idea for an episode? Email us at podcast@rentsync.com.
So again, coming back to the kind of similar question, in your experience, how has that changed, that whole life cycle experience changed given COVID? Like, what have you guys done differently, or have you seen?
Yeah, so a couple things to say about that. We have done some digital staging, which we had not done previously. Like historically we've done pretty high-end staging, and it's pretty expensive and like logistically painful to do that. So during COVID, we have experimented with digital staging. I'm reasonably happy with the results. I think there's a lot of room for improvement. It's certainly not as good as physical. It's getting better. We have also implemented, because you want to stay away from giving in-person tours to the extent possible during COVID, we have implemented, those three-dimensional tours. I'm blanking on the name. Matterport. Yeah, the Matterport tours. And we've also been doing a lot of like having the leasing agents do like iPhone video walkthroughs, both recorded, but also sort of like custom. Like they'll get a prospective tenant on a FaceTime call basically, and just walk through the unit and show them the layout. So some companies have sort of like moved to like totally impersonal, I would call it, leasing, where it's all sort of self-serve and you just go see the apartment without a leasing agent. I believe that high-end apartments are sold. Like, I believe that there is an element of salesmanship there. And so we have not wanted to fully remove leasing agents from the equation. So what we're doing is trying as much as possible. We're giving as much additional information as we can in the ads, but ultimately still funneling people to in-person showings.
No, it totally makes sense. I want to kind of go back to the conversation we had around unlevered yield. So my question was, are you looking at unlevered yield as a result of wanting to have some margin of safety? Also, are you looking at it because you guys are doing like a refinancing model, or am I kind of out to lunch here?
No. The reason is as follows. It is relatively easy to make mediocre deals look tasty by doing two things. Okay. One is throwing a lot of leverage on there.
Yeah.
And two is building out like long-term forecasts that show, rent growth and ultimately an exit at some exciting price, right? Like basically you can take almost any deal. And if you put, 75% LTV leverage on there at cheap enough interest rate, and you show rents growing at 2.5% or 3% a year and expenses growing at 2% a year or whatever, and exiting at the same cap rate that you bought it, like almost any deal looks good. And so we have some major problems with doing that. Like, so first of all, like separately from what it looks like, I just don't want to do mediocre deals. So I want to make sure that we are adding value. And what I mean by adding value is it's very simple. It's like, if you can buy a 4 cap in the market, a 4% unlevered yield, right? I can just walk in and buy a 4 cap, right? If I'm going to go through all this brain damage, of this massive renovation and all this pain and all that stuff to generate like a 4.5, like what's the point?
Yeah.
Like, don't do, like, why would I do that? Right. So the first thing to say is I want there to be a significant increase in value. I want it to be clear that I am actually adding value. And I think, and by looking at things on an unlevered basis, you kind of like get at the heart of that. It's easy to tell when you're adding value and when you're not. So that's the first thing to say. The other thing to say is that we do not use, for the purposes of talking to investors about potentially capitalizing these deals, like we are not in the business of giving forward projections, either about rent growth or expense growth, and certainly not about exits. I mean, first of all, we're not going to sell these things. We're effectively permanent holders. So that's off the table right away. But it's like, I regard presenting people with forward, like long-term forecasts for real estate as like really like intellectually dishonest. Like you can't think of all the people who bought stuff in 2019 on the basis of, 3% per year annual rent increases in Los Angeles. And then COVID hit and the rents went down by 10, 20%, depending on the neighborhood, and that's not, I mean, obviously COVID is an aberrant, as a black swan or however you want to think about it, but it's not like, so COVID particularly it's a one-off thing, but like there are always unexpected things. Sometimes rents grow much faster than 3%. Sometimes they come down. And I do not, because I cannot with any certainty predict the direction or velocity of rent increases, I do not think that investors should use those predictions for evaluating deals. So what we say to people is basically, look, here's what we think the rents are going to be when we're done with this project. And that's based on our existing portfolio. So like, what are we getting right now for rents for similar units in our existing buildings? Okay. That's how we're going to forecast the rents upon completion. What's going to happen after that? I don't know. Like things have worked out well for people who've owned apartment buildings in Los Angeles over the last like 75 years or whatever the number is. So as long as you don't over-lever and have to sell when you have one of these black swan events. So what we say is, look, like if, get comfortable or don't with the unlevered yield that we're offering here. We're going to keep the leverage pretty moderate. We're going to refinance after we're done, but we're going to keep the leverage pretty moderate. And then like, we are going to just trust that in a supply constrained market, if you do a good job managing the building, you're going to be happy about what happens over the long term. But as to what's going to happen in any particular year or couple of years, I mean, how the hell should I know?
No, it totally makes sense. I appreciate that running me through that. Let's talk about marketing and leasing a little bit. And really, I think the tweet that kind of brought you into my kind of attention. Obviously, we agree, but we are seeing it even, some of the larger ones, the people inside of those organizations or operations are getting those skill sets, which they didn't have, to your point, they didn't have maybe 3 to 5 years ago. Now, all of a sudden, like when you're asking a leasing agent to actually use, a camera and do essentially a video tour or understand video, it's in a way it's a different skill set that they had to know maybe 5 years ago.
Definitely. And if you layer that on top of like writing copy for ads and figuring out where those ads should go and tracking where the leads are coming from and all of that stuff, I mean, it becomes a lot. And, we're fortunate to have, so we've centralized a lot of that. In other words, we write the copy centrally. We dictate, for the most part, what pictures are used. But we're fortunate to have a leasing team comprised of like very entrepreneurial, smart, personable people. And, they get paid well for what is effectively like a part-time job. And that's worked out really well for us. And it's one of the sources of our competitive advantage. I'm quite confident, but they're fundamentally salespeople, right? I mean, they're not marketers. And there's a distinction, like obviously marketers are in charge of bringing in leads and salespeople are in charge of closing them. And we try to do our best to help our salespeople bring in the leads, but that's not fundamentally a marketing person. That's a salesperson. Now, very large owners have had serious marketing departments for a long time. I remember it must have been 7 years ago or something, meeting a guy who works in marketing at Douglas Emmett, which is a REIT that owns a lot of apartments on the west side of LA and in Hawaii. And they've had a very sophisticated marketing department for a long time. So I don't mean to say that doesn't exist. I think basically the larger the owner, the larger the management company, the more likely they are to have that sort of capacity.
Exactly.
But it's it just, at a small to medium sized property management company, you just don't have the budget or expertise or career path or whatever to grow internal departments of that type.
So as we come to a close, and before we get to the quick fire round, there's one question that basically ties into, I think, really the first question in terms of like your philosophy, but I want to touch upon it. In 2012, you decided to liquidate your portfolio at the time, and that in a way taught you some lessons in terms of why you wanted to do it this way. Maybe speak to that a little bit before we kind of cap off. We can get to the fun questions.
Well, so I should say that it was all of our deal, or almost all of our deals up to that point had been funded by a good friend of mine from high school. And in 2012, he decided that he wanted to liquidate the portfolio. So because he was our sole equity provider, he had that right. And so we sold we owned the first deal we ever did, but the subsequent 11 or 12 deals were all ones that he had capitalized. So we ended up selling all of those between 2011 and 2012. And, we made some money or whatever, but certainly it wasn't life-changing. And we had several of the buyers of those properties hired us to continue managing them post-sale. So we had the unpleasant experience of sort of watching over the subsequent years as the rents continued to rise and operating expenses stayed relatively low because these were brand newly renovated apartment buildings. And so that was really one of the causes, I guess, of the way we think, the sort of like permanent hold mentality that we have, which is, when you have great assets, don't sell them.
Yeah, it's more and more. I think it's, I personally think it's definitely the right strategy, regardless of the asset that you're interested in owning.
Yeah, I mean, I would say that I want to be careful to say that this sort of a strategy, I would not recommend it in markets where it is easy to add supply. So like there are certain markets that are sort of more like trading markets where you like get in and then you get out because you're worried that on the next upcycle, developers are going to swamp the market with new supply. Los Angeles and a few other cities make it so hard for developers, and there's so much latent demand for those apartments that that there's like maybe to bring us full circle in the conversation, there's like more of a permanent imbalance between supply and demand. And it is in those sorts of markets where I think that holding permanently makes a lot of sense.
Good point, and thank you for clarifying that one. All right, so let's kick off the quick fire round. So basically,
Sure.
I'll ask you a question, and you'll have less than 60 seconds to answer. Moses, are you ready?
Go for it.
All right. What's one thing you wish your phone could do?
One thing I wish my phone could do?
Yep.
Get my oldest children to pick up when I call them.
Okay. All right. Good one. What's the most misunderstood thing about you or Adaptive?
Oh, that's a good one. I think, and this is partially, I guess, because of the following that I built on Twitter. I think very often I get questions from people asking me like what they should do, whether they think some retail deal in Alabama makes sense, or like what they should do about leasing their office building in Des Moines or whatever. And like what has allowed us to be successful is a very narrow circle of competence. Like we know we are real experts in sub-institutional scale Los Angeles apartment buildings. And I have some thoughts on other asset classes or whatever, but I am by no means an expert in them. And no one should expect me to be one.
All right. Next question. What do you believe that others might disbelieve?
I think, as I said before, I think the standard practice in real estate private equity is basically to buy mediocre assets in mediocre markets, lipstick them and use as much debt as possible and try to flip them quickly. And that's just, that's worked out really well for a lot of people. I don't want to poo-poo it. It's a model that's worked really well, but that's for various reasons not what we're going to do. And so we're just going to keep plugging along, buying good stuff in really high quality, high barrier to entry markets, doing really high quality renovations, keeping the leverage reasonable and owning them permanently.
The last one is, what have you changed your mind about lately?
and this is a funny time to be talking about it because cryptocurrencies are like down enormously today. But for a very long time, I have sort of like just literally ignored everything about crypto. Like I just have found the whole thing to be like, a gigantic scam or like maybe if not a scam, then like not, speculative and just like, I have kind of a value investor type framework and everyone can make fun of me about that. But that's just like how I think about the world. And I just couldn't understand and didn't care to understand crypto. But I have recently become convinced of its value in certain circumstances, primarily in developing countries where property rights are not protected and where currencies are prone to like massive devaluations. Again, like today's declines in Bitcoin and everything, obviously shake that faith a little bit. But I've read enough about people in desperate situations needing to run away from where they live and go somewhere else to try to save their families. And how hard it is for people in those situations to bring with them any of the wealth that they have accumulated. And the solutions that people have come up with and, are, I don't know, converting wealth to diamonds and hiding them in their underpants or whatever, or burying jewelry and hoping to come back and get it some other time or what. And so I've become convinced recently that crypto does have some significant benefits for people in those circumstances. And so while it's not ever going to be a big part of my life, I guess I'm kind of glad it exists.
I agree with those use cases that you've identified for sure. So where can people find out more about you on the interwebs?
Yeah, so I think the best place to find me is probably on Twitter. It's just at Moses Kagan. I wrote a blog for like 6 years or something every day. I haven't written on it in a long time, but I do have a mailing list on there. So if you go to kagansblog.com, which is the first thing that you'll see when you search for me, you can read all about the history of us getting into the business. I think I started writing it in like 2011 or something like that. So it really charts our progress as a company. So I suggest people check that out.
All right. We'll put that in the show notes. All right. Well, that's it for another episode. Moses, thank you so much for doing this. Until next time, keep swimming.
Thanks, Mitch.
You've reached the end of another episode of Sink or Swim. Make sure to visit us at rensync.com/podcast to access show notes, key takeaways, and where you can sign up to our newsletter to receive free bonus content. If you found value in this show, please also remember to rate, review, and subscribe. Don't forget to join us next week for another episode. Thanks for listening.